In this week's video, we'll review the latest charts and studies to help us understand why a vast array of fresh market signals are sending a strong message for investors. We'll be moving quickly, so feel free to use the pause button on your video player. The first segment of the video is being recorded off-site on Friday evening, August 5th. Here are the main topics that we'll be covering in the entire video. The employment report on Friday came in well above expectations, and thus, we'll have to continue to keep a close eye on Fed policy. You can make an argument looking at this that the base case right now after the employment report, and this was during the day on Friday, these figures here, is a 75 basis point hike and then a 25 basis point hike, which is not a radical change relative to what we had prior to the employment report. Later in the video, we'll be covering 3 drawdown charts. This is one of them. It was dated August 2nd. Just wanted to make the point that the market on Friday closed higher than it closed on August 2nd. Thus, from a risk-reward perspective, or more importantly, a risk tolerance perspective, it's hard to say any of the commentary that was recorded earlier this week needs to be amended in any way. So here's the look of the drawdown chart when we recorded earlier in the week. See, the S&P closed at the end of the week higher than that level, so thus no change to any of the commentary that follows. And even after the strong employment report on Friday, the S&P only closed down less than 0.2% or less than 7 points. And that tends to align with the information in the studies that follow. For the full week, the NASDAQ was up over 2%, NASDAQ 100 was up over 2%, ETF, Tech ETF, VGT up 2.35, XLK, Tech Sector ETF for the full week up 1.94, Growth Stocks, SCHG up 2.05, ARC finished the week up almost 11%, and the VIX for the full week was basically flat, down a little less than 1%. This is a weekly chart of the S&P 500 that we covered recently. Remember, we said this was different here in terms of weekly momentum relative to anything that we had seen in the rearview mirror during 2022. We still have a strong look here as of the close, the end of the week on the weekly chart on August 5th. Also noteworthy, see, this is a reversal weekly candle here, or a doji, and then you get a reversal. But look how weak the momentum indicator is down here when that happens. Look how weak the momentum indicator is here when you get this indecisive look followed by 2 strong weeks down. This week, this looks a lot better. We finished the week green, up almost 15 points. So not a lot of damage done to this chart, at least yet. Of course, we just trade the charts in front of us. And we were already going to have to keep an open mind about the possibility of significant drawdowns, and that's still going to be true after this report. A few more data points from Friday's session. Scoring system that we've been covering in recent weeks, you might remember, is based on this data set here. We want to try to get out to this level here, these type of returns, and try to avoid the larger historical drawdowns. Because in this case, the drawdown following the signal was significant. This is the type of transition that we're looking for. You may remember the score on Friday, July 8th, we couldn't even check 1% of the bullish boxes. And this model speaks to the odds of a successful bottoming process relative to what a failed rally attempt looks like within the context of a downtrend. July 8th, less than 1%. July 22nd, 4.67%. Last Friday, 14.59%. Did we improve this week? Yes, during the session on Friday, we were up to almost 24%. This is also noteworthy. If you put the ratio of the tech sector relative to the S&P 500 and run it through the same model, which makes sense because this ratio was in a significant downtrend and had a significant drawdown. The score during Friday's session, and this score goes from 0% to 100%, was up to 66.55%. If you went back and ran XLK divided by SPY through this scoring system, and you did it, let's say, between May and mid-June of this year, there were several points in there where this 66.55 would have been zero or very, very close to zero. So in recent weeks, a significant improvement. Let's review 14 breath signals that were just nailed down to see what we can learn. It's a daily chart going back to 1999. It's S&P 500 stocks greater than their 50-day exponential moving average. We've been saying in these videos for quite some time now that we haven't seen anything like this. This chart is dated Friday, July 29th. In the present day, we just moved from the lower blue line to the upper green line. So we moved from a significantly oversold and rare position down here in 2022 to this level up here. It's only happened 4 previous times going back to 1999. After the major low that occurred in October of 2002 in the S&P 500 index, after the major low that occurred in 2009 in the S&P 500 index, after the major low in 2011, and after the major low that occurred on Christmas Eve 2018, and after the COVID low in 2020. We just did it again in the present day. Thus, it might be helpful to ask and answer. How did the S&P 500 perform walking forward in the historical cases? And what was the maximum drawdown looking out 1 year in each case? In terms of performance, 80% of the cases, the S&P 500 was higher 2 months later. 100% of the cases, the market was higher 6 months later, 1 year later, and 2 years later. The average gain looking out 1 year, 27%. The average gain looking out 2 years, approximately 40%. Looking at the maximum 1 year drawdowns from an average and median perspective, not all that intimidating. Average drawdown 4.69%, 21 calendar days. Median drawdown 3.2%. It occurred very, very quickly, only 4 calendar days from the date of the signal. Even though the signal in 2003 occurs after the major low in the S&P 500 that occurs in October of 2002, there's a significant retest in this case and thus a pretty significant drawdown, reminding us that even if good things happen looking out 6 months, 1 year, and 2 years, we should have realistic expectations about how markets operate in the real world. And it's possible you might be thinking to yourself, Chris, the 2002 case and the 2009 case, the fundamentals and the technicals are significantly different relative to what we're dealing with in the present day. That's true. We could have made the same argument looking backwards in 2020. We could have made the same argument in 2018, saying 2018 was significantly different relative to 2011. 2011, significantly different from 2009 and 2002. And yet, the net aggregate opinion of all market participants regarding all subjects on all time frames shifted in each case in a similar manner. Just as the market hit a bull-bear tipping point up here late in 2021, early in 2022, in each one of these cases, the market hit a bull-bear tipping point back in favor of the bulls in each case. And while the permutations and combinations of the fundamentals and the technicals, Fed policy, valuations, anything that you can think of, it's always different. But in each case, once that bull-bear tipping point is reached, the market reversed. This signal and all the signals that we'll be covering this week, none of them predict anything. They simply help us assess the probability of good things happening relative to the probability of bad things happening. Another legitimate concern or question might be, Chris, the chart goes back over 20 years and you only have a handful of signals. Yes, that's true. By definition, a major stock market low after a significant decline, those are rare occurrences. And by definition, we're only going to have a few data points to examine. It's not very often that the stock market falls between 20 and 50%. We have no control over the number of signal dates that we're studying. We could make the same argument about rare weather patterns. Why bother? Like any other study, we're trying to take the data that we have in front of us and learn as much as we can about similar instances in the past to help us discern between the probability of good things happening relative to the probability of bad things happening in the present day case. This was data set 1 of 14. This is data set 2, NYSE stocks greater than their 200-day exponential moving average. In this case, we're looking at a weekly chart going back to 1986. You can see we moved from the lower blue line in the present day to the upper green line. It's only happened a handful of times going back to 1986, after the major low in 1987, after a major low in 1990, after a low here in 1998, after the major low in 2009 in the S&P 500, after the major low in 2011, after that Christmas Eve low 2018, and after the COVID low. Had a similar move nailed down on July 29th of 2022 on the weekly chart. Rather than go through the individual performance tables like we did with the first data set, we'll walk through all of the data sets and then present a summary at the end. We'll summarize this data here for every single data set and signal and do the same for the drawdowns. And one thing important about all of these signals, the commentary here is based on something that just happened in the present day. Observable evidence, hard data. Similar situation here, next data set. NASDAQ stocks greater than their 200 days simple moving average. This is a daily chart. In this case, we only have data going back to 2002, and we're looking at all of it. Similar move here from blue to green has only happened 3 previous times. 2002 after the major low that occurred in October of 2002, after the major low in 2009, after the major low in 2011, and after the COVID low. The 5th time, July of 2022. NASDAQ 100 stocks greater than their 150 days simple moving average. In this case, we're looking at the 10-day moving average for the indicator. Very, very similar concepts. Present day, an observable shift from rare oversold territory up to this level here on August 1st. Similar cases, 2002, 2009, 2018, 2020. In each case, when you hit this green line, similar to what occurred on August 1st, the low was in. Not predicting anything about the outcome in the present day. We can make an argument here that this is a similar shift regarding the net aggregate opinion of all market participants regarding all subjects on all time frames. This move here is similar to this move here, similar to this move here, similar to this move here, and similar to this move here. Very similar concepts. We're looking at a weekly chart, end of the week, July 29th, 2022. NASDAQ 100 stocks greater than their 200-day simple moving average only have data going back to 2002. Only occurred 2 previous times, 2002 and after the major low in 2009. This is an extremely rare oversold condition here on the weekly chart. The only time we've been that oversold, Q4 of 2008, and we didn't get back to the green line until Q1 of 2009. Thus, in this case, avoiding that last leg down that we're concerned about in the present day relative to some data sets. Daily chart, NASDAQ 100 stocks greater than their 50-day simple moving average. Once again, we only have data going back to 2002, and we're looking at all the data. Very, very similar outcomes here. 2002, 2004, 09, 2010, 2011, 18, and 20. Good things happened. The one caveat, we do get a similar move from the lower blue to the upper green in the 2015 case, and we still have another leg down, somewhat of a retest, but a lower low. If you know your market history, you know the S&P 500 bottomed in February of 2016. And we did get a similar move from the lower blue line to the upper green line after the major low, but we also got one before the major low was in. Something that will be reflected in our drawdown data when we summarize all of this. Now notice so far we've looked at breadth data for the S&P 500, the broad NYSE composite, the NASDAQ, the narrower NASDAQ 100. Now backing out broad again. This is the S&P 600 index, which is the small cap index. This data takes the percentage of S&P 600 stocks making new 52-week highs. You subtract the percentage of S&P 600 stocks making new 52-week lows. We just moved from the lower blue to the upper green. Significantly and rarely oversold, similar to this move here after the major low in 2011, after the major low in 2016. And note in this case, you miss the drawdown from 2015. We didn't get down here until the final low, so we moved from A to B, similar to the present day move. Christmas Eve low, we're up here after the low, we're up here after the low. A similar move in the present day doesn't predict anything. And we're looking at all of the data that we have. Only have data in this case going back to 2010. But ultimately, we're talking about shifts, human greed, human fear. Next data set, S&P 500 stocks greater than their 200-day simple moving average. This is a daily chart. I have data going back to 2002. Very, very similar concepts. After the major low, we hit the green line in 2003, come down to the blue line in Q4 of 08, come back up, don't hit the green line until 2009 after the low. Similar situation in 2011. We're down here. When we get back up here, the low is in. We're not that oversold in the 2015-2016 case, so it doesn't trigger the signal. We do get it Christmas Eve 2018 at the COVID low, very similar move from blue to green in the present day. Is it possible we have something like this in the present day? Absolutely, positively, yes, it's possible. But in Q1 of 08, we didn't get down to the blue line. We weren't that oversold relative to this level here. Next data set, S&P 500 stocks greater than their 50-day simple moving average. This is a daily chart. Again, data going back to 2002. We're looking at all of it. Very similar outcomes with one caveat. This move from lower blue to upper green does occur prior to the last leg down in 2009, helping us keep realistic expectations about worse than expected outcomes looking out roughly 90 days. It's the S&P 500 technology sector bullish percent index. We're looking at all the data that we have going back to 1996 on the left side of the screen. Very, very rare to go from the blue line, this oversold, rarely oversold, back up to the green line. That's what a thrust looks like. Look how quickly this occurs. We've only seen a move from blue to green 2 other times. We get to green here. This is in 2009 after the major low. We get to green here in 2020 after the COVID low is in. Similar situation here, NASDAQ 100 bullish percent index. Data going back to 1996. We're looking at all of it. Very rare to move from blue up to green. Only happened 3 previous times, 2002, 2009, 2020, and again in 2022. Similar concepts here. S&P 500 bullish percent index going back to 1996. Very rare moves, only a handful of times. You can see in Q4 of 08 here, we do not make it back to the green line. That doesn't occur until after the major low is in. These are all breadth indicators. S&P 500 advanced decline percent. This is a very volatile indicator, so we're looking at the 10-day simple moving average for the indicator shown in blue. If you know your market history, 2010, there's correction and a low. There's a correction in 2011, and eventually we get a strong rally in 2013. So this is your move from blue to green. 2016, that's that major low in February that we already talked about. We get to green after the major low. Christmas Eve 18, green after the major low. COVID, get back to green after the major low. In the present day, we tagged blue and we made it back to green. It would be great if we had data going back to 1970 in each case. We do not, so we are dealing with limited data sets. That's just a fact, something that needs to be taken into account. S&P 500, percent of stocks making new highs minus the percent of S&P 500 stocks making new lows. Extremely rare to go from blue to green going back to 2010, and we're looking at all the data that we have. It's only happened 2 previous times, Christmas Eve 18 into 2019. When you get to green, the low is in. COVID down here, when you get to green, the low is in. Similar move in the present day, does not predict anything. Now we'll summarize what happened in each case in terms of S&P 500 performance and 1-year maximum drawdowns, and maybe more importantly, relative to our approach, how does all of this potentially help us? On the left side of your screen is an aggregate look at all of the signal dates relative to the 14 studies that we just covered. There's 60 dates. In each case, in each study, your signal date would be this date here when you hit the green line. This would be your historical comparison, and this would be your historical comparison. And this shows us S&P 500 performance in the historical cases walking forward from the signal date, looking out 2 months, 6 months, 1 year, and 2 years. And this table summarizes all of this on the left side of the screen. 80% of the cases, the S&P 500 was higher 2 months later. Roughly 92% of the cases, it was higher 6 months later. The average gain was almost 13%. 100% of the cases, the S&P 500 was higher 1 year later and 2 years later. Average gain 1 year later, a little over 25%. Average gain 2 years later, 39.37. How about the maximum drawdowns? In this case, we have the data sorted from the most shallow drawdown at the top of your screen to the harshest drawdown at the bottom of your screen. And this table summarizes the results. In 40% of the cases, or 24 out of the 60 cases, the drawdown was less than 2%. In 80% of the cases, the drawdown was less than 6% from the date of the signal. 83% of the cases, less than 8%. Approximately 87% of these 60 cases over here, the drawdown in the S&P 500 after the date of the signal was less than 10%. Only 1 case had a drawdown greater than 15%. And on a percentage basis, the average drawdown from the date of the signal, 4.64%. The median drawdown, less than that, 3.65%, and it happened very, very quickly. The median number of calendar days was 6. The average number of calendar days to hit the maximum drawdown was a little bit longer, 40 calendar days. In the present day, in each case, we know the date of the signal, and we know where the S&P 500 closed relative to that date in 2020, and thus, hypothetically, if we put these percentage drawdowns on a 2022 chart, this is what it might look like. What are we looking at here? We're looking at the first 25 cases when we're sorting them from the lowest drawdown up here to the highest drawdown down here. So these are the 25 shallowest drawdowns out of the 60 cases. Hypothetically, in these 25 cases, the drawdown, we would hold the 4,000 level on the S&P 500. And in every one of these cases, if we followed a similar path relative to the maximum 1-year drawdown in the historical cases, the recent low would hold. Looking at the next set, this is 26 through 48. So we're down into the meat of the table here. So in cases 26 through 48, the low that we made recently in the present day hypothetically would hold in all of these cases as well, if we followed a similar path relative to the historical cases. So thus, in 48 out of the 60 cases thus far, the low would be made hypothetically in the present day. Once again, doesn't predict anything, simply helps us assess probabilities. Thus, when we consider all 14 of the studies, these cases here in the middle, it really doesn't look that bad. And relative to these 25 historical cases, there really isn't a lot of pain relative to backtracking, hypothetically. This is where the however comes in. If If we skip over to the worst case scenarios, or the bottom of that table, still not that bad. Almost every single case, with the exception of this case here, aligns with really what we've been talking about now for several weeks, that there's a decent probability that the S&P 500 is going to make a stand somewhere between current levels and this cluster down here. And the NASDAQ has already visited this cluster in the present day, as we know. So this is that 2020 cluster. It starts here in September, and it ends when we get that big rally in early November. So in 59 out of the 60 hypothetical cases based on something that just happened in 2020, we would stay within that range, and that would align with an accumulation type strategy. This is really your outlier here, something that we still have to respect. In the worst case scenario, in the historical cases, that's the false rally that goes into early January of 2009. The drawdown from there was gut-wrenching, 27.4% from the date of the signal, and the low comes on March 9th of 2009. Hypothetically, if something similar happened in the present day, we had a similar drawdown from the date of the signal, that would take us all the way down roughly to 3,000, helping us keep an open mind about a wide range of outcomes. Out of the 60 cases, the average draw would take you to about 3904, the median to 3946, right here and right here, the dotted lines. In terms of visualization relative to the accumulation strategy, again, 59 out of the 60 historical cases keep you above or near this cluster. Conceptually, let's think of these middle tier drawdowns here and these worst case scenario drawdowns, especially the ones that occur above this teal line in here where this area would hold. These historical cases that we've covered in the past give us some type of feel of what that might look like. So this is a retest here in this case. Remember before we talked about prices in the exact same area here relative to these levels here, but your margin of safety over here is quite a bit better, especially when you start moving in this direction. And if things were really to unravel from here in the present day, this is the type of look that we would want to avoid. See this tight convergence look in here? Look where that occurs, and then look what happens after that. And notice in here, your slopes really are ugly the whole time for almost every moving average. Compare and contrast the look in here to the look down here when things are improving. So hypothetically, in the present day, this could be our big rally. This could be a retrace that takes several weeks. And this look in here, all of this is quite a bit different than all of this. And relative to Fed policy and where we are, something like this, we can visualize or understand something like this. If we're down here in this area now, relative to the initial low in this case, not really a whole lot happens. For the most part, you're in a range for several months in here. And as we move from left to right, your margin of safety improves. So it's very, very possible in the present day that things aren't going to get much better in the short term, but they might not get that much worse relative to the recent low. And even in the 2008-2009 case, so hypothetically, you'd be up here, and this is a very, very vulnerable look still. But think about it in terms of price. You're really not below this low for very long in here. If you come down here, this is really just a handful of sessions in here before you're back in this box. And this is a very, very, very painful move here. You move from approximately 925 on the S&P 500 down to that Damien 666 low here in March of 09. A few important points about this, and this. In the present day, the Fed is still raising interest rates. And there's no other way to slice it. That is a significant headwind. And inflation is still a significant problem, which says take all of this with a reasonable grain of salt. And clients and regular viewers know we do not trade historical studies. We trade the charts in front of us. The historical studies speak to odds, which is significantly different from certainty. And none of this is a forecast in any shape, form, or fashion. Regardless of how green this table looks, and regardless of these relatively tepid and non-threatening drawdown numbers on an average and median basis, we still have to take it day by day with an open mind about a wide range of outcomes, from wildly bullish to wildly bearish. All you have to do is think about the 2008 scenario to maintain a level head. All of this is based on something observable that just happened in 2022. That's the chart in front of us. These data sets are part of the data in front of us. And in each one of the historical cases, there was a shift. The net aggregate opinion shifted from net bearish to net bullish. And in many cases, that takes time, sometimes several months. In the present day, we are attempting a shift in the present day. We're still dealing with relatively weak trends. The trends have work to do. And really, 59 out of 60 of the historical cases align almost perfectly with the accumulation strategy that we've been talking about hypothetically over the past several weeks. With the exception of one case, even the worst historical drawdowns take you down near that cluster. Since the CCM market model uses a weight of the evidence approach, let's review some additional data to see what we can learn. Sentiment, American Association of Individual Investors, bulls minus bears, covered it this slide in the July 22nd video. Only two other times have we been down here, 1990, 2009, and the present day. Made it back to the red line here, made it back to the red line here, made it back to the red line here. Case number one, the 1990 case, when you made it back to the red line, the low was already in the S&P 500. Didn't mean the volatility was over, but the low was in. 2009 case, down here, made it back to the red line. The low was already in. The low comes on March 9th of 2009 in the S&P 500 index. With like a little bit slower signal, this is the same data now. This chart's dated July 29th, so as of the end of last week. This data only comes out once a week. In this case, we're looking at the same data set, but we're looking at the 4-week moving average, so a little bit slower. Similar situation, 1990 case. When you make it back to the upper blue line, the low's already in. 2009 case, when you tag the lower line, make it back to the upper line, the low is already in. We just did something similar in the present day. Going back 35 years, only two previous times, both of them occurred near a major low and really after a major low. Thus, something like this has only occurred two previous times in the last 35 years, both of them significant. Since we just hit the upper blue line on July 29th, it might be helpful to know how the S&P 500 performed after the two previous signals. In both cases, the market was higher 3 months later, 6 months later, 9 months later, 1 year later, 2 years later, 3 years later, 4 years later, and 5 years later. Average 1-year return approximately 30%, the 2-year return a little bit over 46%. Drawdowns relatively muted in both cases, under 5%. The average was 4.19. Average number of calendar days to hit this drawdown level, 18. This is S&P 500 performance. How about the NASDAQ 100? Average gain 1 year later, 52%. Average drawdown, looking out 1 year, maximum drawdown, 3.15%. What about the topic of an economic recession? Well, if you know your market and economic history, you know that 1990 featured a relatively shallow recession, and we had a significant recession in 2009. So the two previous cases were recessionary cases. As we've mentioned in these videos in the past, a recession is only declared after the fact. So the 1990 recession was declared to take place between July of 1990 to March of 1991. So after the fact, the recession starts here and ends in this area here. you can see the stock market bottoms well before the recession ends. And maybe more importantly, the stock market bottoms in October of 1990 here. The recession still wasn't called in December of 1990. So the stock market bottoms here. Real time, we still don't know if we're in a recession here. The recession isn't called until 6 months after the S&P 500 bottomed. Here's the press release up here. April 25th, 1991. This is when they call the recession. Thus, at this point, the recession topic may not be particularly helpful because it may not be called until well after the stock market bottoms. Also noteworthy, the situation in 1990, here's a little blurb down here, similar to the present day situation. If you're a client, you can understand our strategy, our asset allocation strategy. If you look at this chart here, it tends to align with this data almost perfectly. What this shows you, this is NDR research, here's the Twitter handle up here. Guessing this was published after the S&P 500 dropped 18%. So what it shows you is, here's the 18% drop. The dotted blue line shows you the path walking forward after the 18% drop in the recessionary cases. The black line is the non-recessionary cases. You can see they're radically different. So in the present day, we dropped, and we're roughly in this position here. And in both cases, recessionary and non-recessionary cases, after an 18% drop, the market had a sharp rally. In one case, the low was in, if you're not in a recession. If you are in a recession, in terms of the average path, you get a retest for the most part. The bad news is you fall. The good news is, relative to the average path, this low here is slightly above the prior low. So this too would align with an accumulation strategy. If we follow this type of path, you don't want to be in 100% cash at this point. And if we follow this type of path, you don't want to be fully invested at this point. This is a significant divergence relative to that recession question, which we won't know until after the fact. So how do we handle it? We trade the chart in front of us. If the chart in front of us looks more like this, then we're probably going to avoid a recession. If it looks more like this, then most likely a recession will be declared after the fact. We want to be able to handle both cases, and hence our current allocations that are in line with the data and the weight of the evidence. Where we go from here is market dependent, day by day. You pause your video player here. This is another way of looking at a breadth thrust. You can see historically good things typically happen after these type of clusters. This is the third weekly video where we'll be pointing out a subtle shift in a data point. You can see NASDAQ stocks greater than their 200-day exponential moving average peaked a long, long time ago, about the same time ARK peaked in Q1 of 2021. This is the first time we've been able to pop above that downward sloping trend line. Very, very subtle, but possibly relevant. Any of the remaining data sets that we cover were not included in the 14 studies that we covered in the open. Very, very similar concepts here. This type of move typically was associated with good things in the stock market. This was a study that we covered in a previous video, and thus it's still part of the weight of the evidence, S&P 500 returns, maximum one-year drawdowns. This was not included in the 14 studies that we covered previously this week. The same goes for the rest of these studies. Similar situation, part of the weight of the evidence just wasn't included in the 14 studies. Typically, when you move from blue to green, good things happen. In every one of these historical cases, when you went from blue to upper blue, good things happened in the stock market. It doesn't predict anything in the present day. This just points out that the market, looking at all the data we have here going back to 2002, we were definitely in oversold territory where bottoms tend to occur, right in that sweet spot. If we look at NASDAQ 100 stocks, the percent of them greater than their 200-day simple moving average going back to 2002, there's only one other time in history that we were this oversold. The only other time that we've been down here, the financial crisis. And we could make an argument that that means we could have significant pain ahead before this is over, and that absolutely positively is true. However, looking at this data set in isolation, when you were down here, we were down here recently, when you were down here, when the indicator made it back into the green box, the low was already in. On the present day, we're in the green box, telling us, as far as this data goes, it's possible, or at least we can say the odds of having that second leg down, that double-digit, very painful leg down, I think we can make the argument they're lower today than they were a few weeks ago. Doesn't mean we should rule out a significant draw from here. We've been using a wide array of indicators tied to a wide array of indices and sectors. This is about as broad as it gets. The S&P 1500, new highs minus new lows percent. In every single case, we only have data going back to 2010, the low was in when you move from here to here. Present day case to be determined. Everything that we just said about the last data set applies here. Tech sector, new highs minus new lows percent. In this case, we're looking at a slower signal. This is the 10-day moving average of the indicator. If you examine this chart, typically when you move from blue to green, after that, good things tended to happen. This is mid-cap stocks. This is the percentage of stocks in the S&P 1500 making new 52-week highs minus the percentage making new 52-week lows. This is similar, but it's just looking at advancing issues minus declining issues. You don't necessarily have to be making a new high or new low. So a similar yet different data set, also pointing to an A to B move that typically was followed by good things in the stock market. And notice how quickly this takes place. This is the type of thrust look that we've been waiting for. Here's a thrust look here. There's a thrust look here after the COVID low. Thrust look here after a Fed pivot in 2016. Doesn't mean we're out of the woods in the present day, just speaks to odds. NASDAQ 100, new highs minus new lows percent. In each of these cases, good things happened and the low was in. We just moved in a similar manner. Should be reiterated, as we mentioned earlier, we do not trade historical studies. This just helps us keep an open mind about better than expected outcomes. Again, looking at mid-cap, good things happened, good things happened, good things happened, good things happened. Similar move in 2022. In every single data set, these three letters, TBD, are extremely important. We trade the chart in front of us. June 1962 case, 1962-63 bottoming process. Notice it takes time. Sentiment shifts over time. You can see a similar shift taking place if you pause your video player here. Dark and filled diamonds are the present day. This is the look 3 months ago. 3 months ago, almost everything is in the bearish category. Now we have quite a bit of black over here. We have seen some weakening in a still strong labor market, and we have seen some anecdotal evidence of inflation cooling off in some shape, form, or fashion. Obviously, all of this is taken into account relative to Fed policy walking forward. And since we have countless moving parts in 2022 and 2023, including Fed policy, inflation, and weakening economic growth and weakening earnings potentially, the only way any of this works is if we head into next week and every week with that flexible, unbiased, and open mind. The material in this video has no regard to the specific investment objectives, financial situation, or particular needs of any viewer. This video is presented solely for informational purposes and is not to be construed as a solicitation or an offer to buy or sell any securities or any related financial instruments, nor should any of its content be taken as investment advice. Any opinions expressed in this video are subject to change without notice, and Shavaco Capital Management, LLC, or CCM, is not under any obligation to update or keep current the information contained herein. CCM and its respective officers and associates or clients may have an interest in the securities or derivatives of any entities referred to in this material. CCM accepts no liability whatsoever for any loss or damage of any kind arising out of the use of all or any part of this material. We recommend that you consult with a licensed and qualified professional before making any investment decision.